Time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joining us on what has been a wild week. Your big show coming up in just a bit here, and I know you've already spoken to some folks about what's been going on.
Yeah, 6 p.m. Eastern time will be up, and thank you for welcoming this week.
Absolutely.
It is, you say, quite a week to launch this daily segment. Let's talk to somebody who has spent his career in banking. He's Bob Diamond. He's CEO and founder of Atlas Merchant Capital. Of course, he's been in banking his whole career, including running Barclays. Bob, thanks so much for joining us. From where you sit, knowing banking as you do, what do you think went wrong here?
I don't have perfect information. No one really has it. But David, my sense is, if you go back to a year or so in COVID, as interest rates moved to zero very quickly, people were liquidating securities and increasing deposits. And as an institution, SVB was increasing their deposits significantly. The growth was quite remarkable when you look back now at those numbers. And people were willing to take zero because interest rates were zero. So they would move out of treasuries and out of other securities into deposits. And over some period of time, SVB was earning the other side of those deposits with not short-term securities, but they extended to 10-year securities, mostly mortgages, it looks like. As interest rates started coming back up, which I think we've all talked about. It was a fairly well advertised time to raise rates because of the raging inflation. But as that happened, and there wasn't a lot of that spread paid to the depositors at most institutions, those same people were taking money out of deposits and going into treasuries and going into investment grade credit and going into other securities. And so the amount of insured deposits reduced significantly. And yet that fixed portfolio of 10-year mortgages was still there. And it was a significant increase in the unrealized losses from that treasury book, which is, quote unquote, available for sale. So it's not marked to market. And the unrealized losses were growing. I think the other thing that surprised me, and not having been a customer of SVB or as familiar, I hadn't realized this, but they weren't a federally regulated bank. They were a state-regulated bank. So it was California is the key regulator. And as I understand how it works, then the Fed looked at the holding company. So I think there were a number of issues. And then lastly, I would just say that it was very surprising to us that it hadn't been more recognized how high the percentage of uninsured deposits were to the overall deposits. And it was in the 90%.
But Bob, I think it struck a lot of us that we thought the banking system was really very sound and heavily regulated after 2008, 2009. All the things you described, shouldn't they not have been known to the regulator, whether it's the state regulator or the San Francisco Fed? Because if you looked at the financials, it looked like they had unrealized losses that equaled their equity.
Yeah. I think, to be honest, I'm pretty sure that was a footnote in all of their reports, even public reports. So equity investors would know that as well. And I think it's a fair question to say, why did it take so long and my understanding is one of the rating agencies began discussions with them, kind of a month or so before that.
Bob, I am curious about the potential fallout for capital markets in and of themselves. This idea here that the cost of capital is going to go up, particularly in light of the idea that the FDIC will, of course, have to saddle banks with higher fees, of course, to bolster their insurance system and any other additional regulations that could come down the pipe.
So I think, Romain, the other thing that I discovered here is that SVB was one of the banks to benefit from the rollback of Dodd-Frank regulation. And as you recall, Dodd-Frank had different categories of assets in the bank that triggered different capital levels and leverage levels. And SVB, during the Trump administration, had the capital levels and the leverage levels rolled back so that more leverage could be done with less capital. And I think we have to look back at why was that rollback done? Was that appropriate, or was the Dodd-Frank rules to make banks? And, I look back at 2008, when I thought about that period afterwards, I always thought about the regulatory response as, how do we make banks safer and sounder while allowing for economic growth and job creation? And if you don't do both of those, on the one hand, you're going to have, too little capital and you can have problems happening in the bank. On the other side, it's you have a lot of capital but no profits, you're not going to have investors. So it's really balancing those two things. And I think we got away from it a little bit when we
Yeah.
rolled back some of the regulation that came out from Dodd-Frank.
I am curious, though, as to, so we obviously we don't know how this is going to shake out on a regulatory basis, but there has been people questioning kind of the U.S. model of a banking system.
Yep.
That idea is very disparate, particularly when you compare it to a more concentrated European banking system, and even in Asia. The idea that regulators, in theory, would have an easier time just watching over, a handful of bigger banks rather than this wide swath of hundreds of different smaller banks.
I take that complete opposite view, Romaine, from what you're saying. Not that that's your view. I don't mean that, but I think one of the pillars of our economy is the incredible depth, liquidity, and diversity of our capital markets. Private equity, venture capital, high yield funds, so many different ways for businesses to raise capital in good times and in bad. And one of the underpinnings of that is the thousands of banks that are not bulge bracket, Citibank and JP Morgan. It's regional banks, it's specialist banks really tailored for the healthcare industry, for example, or community banks in small towns around the country. And I think that's been something, I think that is something that we should treasure and something that we should protect. And my own mind is that we're going to find the regional banks and the specialist banks and the community banks almost uninvestable until we come up with a policy response here that's supportive of them. And in my own mind, I think part of that has to be higher levels of deposit guarantee funded by the FDIC and funded by the banks. And I think it's very doable within the banking industry that this would not tap any taxpayer money. It would be a tax on deposits for all the banks, and it would create a fund that could dramatically increase, the size of the deposit guarantee.
Bob, I certainly take your point. There's some strength in diversification. You don't have all your eggs in one basket. Get the point. At the same time, one of the corollaries is that means there's a lot of places there could be a mismatch, whether in the banking system or outside the banking system, on liquidity, on duration, such as we saw at Silicon Valley Bank. So what about other banks? Where should we be looking right now for that mismatch? And by the way, what about private equity? What about commercial real estate?
We're all looking for those mismatches. And I know our team, I spent an hour with them downstairs looking at all these kinds of numbers that came out as you and I were talking about earlier for all these banks. And I think, the policy response needs to be to protect investors, but it shouldn't be to protect management. It shouldn't be to protect bad business models. It shouldn't be to protect equity investors. It shouldn't be to protect unsecured investors. So, I think that it's okay to have failure. But I think for so many people putting deposits in their banks, that's where we have to provide some comfort. A lot of those people aren't equity investors. They aren't doing the kind of research that you and I are just talking about right now. So it's absolutely appropriate that we allow for failure. But I think the comfort that we need is that there is a higher level of deposit insurance so depositors are protected.
Well,
and we can have a more diversified, thousands and thousands of banks, which I think is really healthy for our economy.
Higher level of deposit insurance. Right now, as far as I can tell, it's going to be hard for the federal government not to insure every single deposit, no matter how big it is, for every bank. I mean, why would it be limited to this particular situation?
Well, I think right now that's part of, as you and I talked about earlier in the week, David, that bank run is what happened last week. And that's all about confidence and all about momentum. And I think what the Fed did to basically insure all the deposits at those two institutions, I don't think that's the policy they want to go out. I think we can manage with a limit lower than guaranteeing all depositors. But I would agree with you right now, until there's a policy response, that's pretty much what's implied.
I'm curious, Bob, and I don't know if you know the answer to this, but the idea, at least based on what the government has said with regards to making depositors whole, and the idea that this sort of rescue bailout, whatever you want to call it, is funneled into deposits and not necessarily into capital liquidity into the banks themselves. There is a distinction there, and I'm wondering if that distinction matters.
So, I think that comes to what I was saying earlier, Romaine, if I understand the question right, which is, a lot of these banks are going to have different business models. A lot of these banks are going to execute differently, and therefore they're going to get better share price response or better support for their unsecured debt. And I think that's how the system should work.
Does this end up creating a situation where the bigger banks, the big money center banks, those systemically important banks, then grow to dominate this market much more so than they do now?
Listen, there's kind of two big worries I have here. One is just that. I mean, prior to this crisis, less than a week ago, the top four banks in the U.S. had well over 50% of all the deposits. It's moving toward 90% if we don't do something here. And I think if that's the case, the only person that's going to claim victory is the original JP Morgan, which is you have one dominating institution in each sector, Standard Oil, JP Morgan. And I don't think that's what any of the big banks want either. So the second thing I would say that is very clear to me is the banks are becoming increasingly more like utilities, closer to the government. We've seen a lot of it since 2008. We saw it yesterday with the Fed and the Treasury and 11 banks, providing support for First Republic. So let's get over it. Of course, there's a bit of a utility aspect to banking. It's a highly, highly regulated industry. And what we're saying is we need to be a little bit more thoughtful and proactive on the level of protection for depositors for the benefit of the breadth and depth of our banking industry. And I think that's the right policy response.
Bob, that's a larger context, which is terribly important for the longer term. What about right now, right here? We've got the Federal Reserve trying to fight against inflation. We've got the decisions coming up next week. At the same time, we really have sort of shaken the foundations of the financial system. What is the likely effect, do you think, over the next 6 months, 12 months, in the willingness of banks to lend, the credit situation, really to keep the economy going? Are we more likely headed to a recession now, given what's happened?
No, I really don't think so. I think if the deposits move from small banks to JP Morgan, you still have deposits and you still have, credit growth. So I don't think that this should have a material impact on the economic growth going forward. I do think in any situation like this, though, David, you do have a flight to safety, a flight to comfort. So you're going to see a rally in treasuries, unsurprisingly, as people want to be in the safest security right now, not as concerned as much about returns. But I think for the Federal Reserve, I don't blame what's happened on the higher rates. I mean, the higher rates were a reaction to inflation. And a year ago, we had inflation absolutely raging at 9% and going higher. If we did not raise rates, inflation would be at least 9% today and probably significantly higher. And that would be having more of an impact on the banks and more of an impact on the economy. So let's not blame this on the Fed and the rate increases. What I blame on the Fed to some extent is they waited too long. We all know that. They've even been very, very clear inflation got too high. But the fact that they're managing as aggressively as they are, thoughtfully, publicly, to get inflation back down, I think has been thoughtful. So when I look at next week and the decision that the Fed has, I was kind of thinking 25 basis points now and maybe one more 25 basis points down the road. We talked about it. Rates are around 5%, and then they pause.
Right.
I don't think there's any chance of 50. I don't think there was even before this. Maybe it's 0 this time, and they wait till the next meeting. Maybe it's 25, and then they pause before 5, a little bit lower. I don't think it's a big change, David.
Right.
But on the margin, I think they'll be thoughtful about the impact on the markets.
Well, so funny, to that point, Bob, let me play it the other way around. Bloomberg Economics today had an estimate out that the tightening of financial conditions we've seen just this week amount to something like 50 basis points. Should the Fed be taking that out of whatever calculus they're thinking about for terminal rate?
No, I think that was this week. I mean, if you saw a lot of stress this week. I don't think we should extend that out. But I do think that if they do 0 and wait till the next meeting, it's not the end of the world. My thought is they probably what I would expect is they would do 25, but probably soften the language a little bit in terms of what it is going forward.